Is people are like, well, why does the Fed continue to try to wreck this thing? And the reason is because of what I believe I just said. Until they see that unemployment is going way up, until we see the spending frenzy go down, which is driving these prices up, until you're no longer getting multiple offers on a house with 7% interest rates, the Fed will not stop. What happened this week? Kind of give us a recap. We'll break down. There's a lot of things that got released today, but just give us a high level recap of the housing market.
Sure. So housing market, good. Interest rate market, bad. And that's a pretty good recap for it all. There's a bunch of data went in there. As far as rates go, the last really since the end of May, we've been in this same channel of like mid to high sixes, right? And we're finally getting on a path of seeing those come toward the mid sixes more consistently. We were locking some loans earlier this week at like the 6.375, 6.5 range, and things were going pretty well until yesterday. And yesterday we got updated GDP, revised GDP figures, which showed up. They were 0.6% higher because we showed basically a 0.15% increase. So when you annualize it, month over month or even quarter over quarter is a very small increase. But when you annualize it over the year, it looks like a really big number, which is just saying like, hey, there's, as much as the Fed and what we're trying to do to combat inflation, the economy and our GDP is just so resilient that it put into the market like, man, this Fed is just going to continue to squeeze and squeeze and squeeze until they get the economy to break. And it's just not breaking right now. And so we saw that happen. And then we saw the same day, one of the big economic indicators that we look at is jobless claims, because that's a leading indicator of an economic recession is, okay, how many people are claiming unemployment for the first time and how many people are applying for unemployment beyond 5 weeks. And that number dropped considerably. It dropped 26,000 claims. And there's a little bit that was done on a shortened week, because if you remember, we had a holiday on Monday of last week for Juneteenth, or this week for Juneteenth. And so that did shorten that. And we had kind of an absent week almost because of where the 4th of July falls and the way really people have treated this week. So it's kind of a weird week, but having both of those fall on the same day erased any gains we've made in the last 30 days, so It's kind of a funky week for sure.
So let's do this for a second. Maybe there's a newer real estate agent, or maybe a newer mortgage person that listens or watches the show perhaps. And I think the question I often get, and I want to get your take on this, is there's two stories happening here. There's two sides to the equation, in that one side is saying what you're saying, as they're taking it as like, well, this is good news. What is the problem? Like, unemployment is, these are good indicators. Why do you oftentimes, not you, Steve, why do people in the housing market often talk about things aren't good? Why would we want to break the economy? I don't understand. Can you know what I'm asking, right? So Can you understand, can you break down for the person that's new to the real estate industry why we speak from that lens?
For sure. And really, you don't even have to be a new real estate agent. You just have to be somebody that has a wallet. And the reason for that is it all goes back to inflation, and we're using, the Federal Reserve is using all these tools to slow down prosperity, right? They are trying to make the economy stop growing. And the reason we want the economy to stop growing is so people stop spending money. And the reason we want people to stop spending money is because the price of goods are outpacing the rate of increases in people's take-home pay. And so as we have prices going up on goods and wage growth that doesn't match that, your dollar doesn't go as far. And so as an American, because you have to think, right? Inflation was up 9% last year. And now we look at the inflation numbers came out today, and it's up 4.6% this year. That doesn't mean that prices are up 4.6% from 2 years ago. that means prices were up 9% last year and an additional 4% this year. So we all know that we're not making 13% more money for the same work, but we're paying almost 13% more for the same goods.
Too
And
many
so
too many dollars chasing too few of goods.
exactly, 100%. And so, in order to get, so historically, right, the way that you would do this is you have the Federal Reserve raise their federal funds rate, and that slows the economy. It makes it harder to do business. It makes it harder to grow for these large corporations, which eventually trickles down to layoffs, uh, cutting pay, decreasing hours, decreasing innovation, and all these things. And that's how you get it to trickle in to Main Street, which I always talk about, right? To us.
Yeah.
And that's how you get it to trickle into that part of the economy. That you're right. And people should be like, I mean, this is like the last thing we want to do is walk around and see strip malls closing and, overgrown yards and houses that are foreclosed and things like that. But at the same time, the pace at which prices of things are going up, especially in the housing market, it's just not sustainable. I mean, we'll get into it with like new
Yeah.
construction homes. The median price for that's $416,000 to build a house today. And that's the contract price.
That's
And
right.
so as a new real estate agent or somebody that's just trying to get an understanding of why we would view less unemployment claims as a good thing is because the Federal Reserve is doing certain things to try to slow this down, and it's not working. So they're going to continue to do that longer and longer and longer until something breaks. And the fear is that the longer you have to try, the harder you try to break something, the harder it's going to be to fix once you do
Yeah.
break it. And that's the concern, right? So
Yeah.
then you look at how did we get here? So we've got like massive $1 trillion spending packages and relief packages and all these different things. By the way, I haven't seen it pop up yet on my computer, but the Supreme Court is about to rule on that student loan program,
Mm-hmm.
student loan forgiveness program, which will be pretty interesting to see how that goes. But anyway, there's just been so much money pumped into the economy, and again, it was necessary. I believe 100% we had to do that. The problem is we're still reeling because we're just so used to these numbers like millions and billions and like, oh, they got to fix that bridge over the highway. It's a 3-lane bridge, costs $68 million to fix like a 38-foot piece of road. And we're
Yep.
so used to that. We're pumping trillions of dollars into the economy. I mean, it's just a ton of money, for lack of a better word. So
So
that's why.
yeah, makes sense. Thank you for that. Because the other thing you said is the thing I find so fascinating is everything the Fed's trying to do. What we're trying to fight is high the prices of everything going up. But it seems as though the American people don't care. Not that they don't care, it's not working. I mean, the more expensive things get, it seems like the lines just keep getting longer. I don't know
Yeah.
about you. We talked about this last week, but as the Fed tries to slow down the economy, the lines at Louis Vuitton aren't getting any smaller. The lines at the
Yeah.
Jordan store buying these kids $450 pair of shoes isn't getting smaller. So in your opinion, why is that the case? Because what you're saying is the reason why mortgage rates are responding like dog doo-doo is because people are not stopping. The spending isn't stopping. So how can that be true that prices continue to go up and it's not breaking? What's your take on that?
I think there's a lot of factors. We're coming off a time when Americans have had the highest amount of savings, cash savings, and the lowest amount of credit card debt. And those are both becoming inversed rapidly. And I think a lot of that comes from one, revenge spending. I think there's a lot of people that, and we're seeing it slow down on goods, which is good. That's a nice thing to see. However, we're not seeing it in the services sector, which means
Got
going
it.
out to dinner, going out to lunch, and traveling. And revenge travel is a very big thing. I don't know if anybody's looked at vacations lately, but number one, you got to book like a year in advance, and the prices are astronomical, and people are still flocking to that. So I do think there's some revenge spending. You have to think too, and they don't talk about it a lot, but there has been, when you think about all these people that were, and I see it every day because I deal with credit reports all the time, and you're always shocked when I tell you these things. I'm like, people have like 40, 50, $60,000 in debt on credit cards. A lot.
Yeah.
And the last couple of years, they have gotten to wipe all that away and put that into a 30-year mortgage at the lowest rate it's ever been. So, a lot of people have clean slates where they've been one able to save
Mm.
cash, they've been stimulated with extra cash, and they've got these massive lines of credit that they kind of learned their lesson on and are using them a little bit more,
But not
I
really.
guess you could say, a little bit more strategically with paying for some of this stuff. But we are seeing credit cards go up. Now, this last month, and looking at some of the personal consumption expenditures, we are seeing savings rates increase a little bit again, which is overall a good thing. Like, I think that financial well-being is a prominent thing especially among younger generations. People are really taking that very serious, which is a good thing. But yeah, the other part of this is, and it's the side hustle culture, and there's a lot of people out there that, they might work a 9 to 5 job, or they might be a real estate. Like, I've known real estate agents that'll do DoorDash while they're as a real estate agent. And a lot of that side hustle culture funds some of these extravagant purchases too, which is crazy to think about, but it's a good way to not dip into your regular budget to buy some of these items.
Yeah. So the long and short of it is, until the Fed starts to see some of this damage that they're looking to create actually come to fruition, they're not going to stop. Until
No.
unemployment really starts to go up, until things start to get bad, they're not going to stop. And as a result, mortgage interest rates just keep being stubborn, is the way I would put it.
Yeah. Yeah, and there's some technical stuff too, right? So you have the banks you have a lot of these regional and smaller banks you have a lot of, I mean, if you look at it, like Chase and Bank of America and these massive banks have not changed their saving rates. They're still garbage, right? Like, there's
Yeah.
no interest on cash savings. Where a lot of like regional banks and credit unions and smaller banks are like you probably see with, I know we both use UBS, and you see their 5% savings rates
Yep.
and some of that stuff. And so what's happening is a lot of people are taking their money from different banks and institutions and investing it in money markets or buying bonds. Like, we're doing I bonds at like 10%, and all these different things. And they're taking their money out of these banks. Well, in order for these banks to create that liquidity, they have to go back into their mortgage-backed security and 10-year treasury portfolios that we talked about, that big institutions hold on to. And because the rates of return on those are so low, and it's not quite to their maturity day yet, they're selling those at massive discounts. And we're seeing a lot of that flood the mortgage-backed. So a lot of our
Mm.
mortgage-backed securities and treasury buyers, we still have to absorb all these things, which will naturally work itself out. But there's still a lot of unforeseen things coming with these banks. And now that we just had some stress tests last week, and we're showing that banks are gaining strength. So hopefully we'll start to see a little bit less of that too.
That's another great point. All right. So let's get into some of the things that is affecting everything we're talking about right now. So what came out this week that's contributing to what we're seeing in the market right now?
So as far as rates go, so I told you we saw the GDP, which is the stuff America makes and sells. We saw that came in higher than expected, which is showing a resilient economy. We saw the unemployment claims come down. And then today, we got our personal consumption expenditures index, which is called PCE. And that is the one. So we talk about 2%. The Fed talks about seeing inflation getting down to 2%. Well, what they're really looking at is core PCE. And then every time the Fed talks, they add or remove something. So there's like always an asterisk for that, but they're really looking for it to be 2%. So that came back at a 4.6% today, which is better, right? So it was up 0.3% for the month, and it was estimated to be up 0.4%. So we beat expectations. But it's still at 4.6%. And that is the one that has been the most stubborn. So that takes into account what Americans are spending their money on. That does not include food and energy. And so that has been a bear of a number. If you look overall, if you include food and energy back in that number, it was only up 3.8% this year. So the reason that there's that variance there is because we are starting to see the price of energy come down some. and the price of food rising very little compared to what it was a year ago. So still up, right? So even if the price of food is only up 0.1%, it was still up 9% multiple times last year. So you have to think like that. It's not, and that's just on what we're spending. You're not looking at the price of manufacturing that good, the price of getting that good to the market, where all those things are compounding. So again, that was a little bit better number than we had hoped for, but it still isn't enough to get the market super excited, knowing that the Fed is in the background saying if we don't continue to see improvements in some of these numbers, we're going to keep your rates higher for longer than we initially planned on. And it makes more of a case for another two potential hikes this year, which they alluded to in their last Fed meeting.
Yeah. Yeah. I mean, because now just give us, as a result, you talked about earlier on, rates, you're locking rates at 6.5. I mean, they've climbed right back up over 7 again. Is that right?
Yeah, depending on what you're looking at, we saw like a quarter to 0.3% increase in rates just yesterday, um, and so it is. I mean, that's really this channel that we're in right now. You're going to see interest rates, and for agents out there that and people looking at buying homes, I could talk to you on Wednesday and lock you at 6.5%, and I could talk to you on Thursday morning, 12 hours later. I could talk to you at 9 p.m. and at 9 a.m. you're at 7%. That's how drastic that change is. And so what I'm telling a lot of my buyers and the agents that I work with right now is that when you have a verbal offer accepted on a property, call that lender that day. So like, hey,
No doubt.
what are rates looking like today? Like, what will my terms be? Because that lender, as long as there's a contract being signed, you can lock in a rate. You just pop that address in. You hope it all goes through, but you certainly, I mean, you're talking 0.5% on a $300,000 loan is $250 a month, or, it could be significant. Well, am I saying that right now? $125 a month, but either way, it's just a big change that you've got to be ready for.
So when you're um someone's looking to buy a house, you do a pre-approval, they find a property, that's when you can lock a rate potentially. I mean, you're right. I mean, rates are just so all over the place. Are you locking? Are you floating? Is it tough? Is it all situational? Talk to me about that.
So there's a lot of thought. Like I know, a lot of mortgage guys that like to float their rates and they like to kind of play the market. I'm first of all, I'm here to serve the client, right? So I provide them with information, and then it should lead. Ideally, I should be able to put that in a way that leads them to making a decision. And so you just simply say, look, when you pre-approved for a loan, I'm really happy for you. I'll get this over to your agent, blah, blah, blah. Tell the agent when you guys make offers, let me know once so we can present our pre-approval to your seller. Call them and have that conversation about how great our buyer is. As soon as I hang up that phone call, I call that buyer and I say, listen, made the call to the listing agent. I know that you guys have your offer in. If this, as soon as you hear that they're going to, even if it's a verbal acceptance of your offer, please call me. Here's why. Interest rates are this today or this wherever they're at. And we can lock as soon as you have a thumbs up from them. And I want to have the conversation with you of do we lock or do we float? You'll be able to make the decision. I'll give you my opinion and kind of what I would do. But that will be up to you. And I am right now, honestly, I'm telling people to lock. They go up a lot faster than they go down. And I think it's a smart time in this market to lock your loan. Obviously, you're going to make your own choice. Every loan officer does it their own way. But as a consumer and as an agent representing a consumer, I like to make sure that these people know exactly what they're going to get today and that we don't know what we're going to have potentially 2 hours away.
Yeah, I love it. If they're comfortable with things the way that they are with this pricing, makes zero sense to gamble, right? Because the likelihood
Right.
is that they get something worse. Two last things for me. One is, of the transactions that you're putting together, when are you? How often are you seeing, or when do you think it makes sense to start to look at potentially some seller financing inside of an interest rate? So maybe some concessions, and how to structure that in a way potentially you're giving the seller a little bit more so that we can use funds to invest in an interest rate. Does that ever make sense? I guess that let's talk about that first off.
So yes, in this market, there's so we do all of the pre-approvals I'm doing right now because we're in such a seller's market. I'm not even bringing up concessions.
Right.
You talk about it. That's a conversation I'm having with the agent. If somebody doesn't have the money to pay their down payment and their closing costs at the time of pre-approval, I'm telling them that, look, your chances of getting a seller to cover these costs right now are really slim. If we do get to the point though, which we are seeing, like I saw a saying the other day that was something about get the house under contract and negotiate later or something, which people are doing, which I think listing agents hate, that, coming back and just negotiating on the inspection. And obviously I don't have anything to do with that, but we're seeing it more. And I'm big on break evens, right? So I tell clients like, hey, that what we can use this for is decreasing your cash to closing or decreasing your monthly payment. Here's what that looks like from a rate buy down perspective right now is that interest rate sheets with lenders are all being sold with points right now. Like they're like the true 0 point rate for a loan right now might be like 7.75%. And a 1 point rate might be like 6.75%.
Mm,
So if I can pay 1% on a $200,000 loan to lower that rate a full percent, you're talking about saving $2,000 in a year by paying $2,000 up front. That makes sense every single time. And the reason that we're seeing that in this market is because lenders right now know that the life cycle of a mortgage is going to be very short because as soon as rates drop, there's a million hungry mortgage guys out there that want to hammer all these refinances. And as soon as those rates drop, those people are going to get phone calls and those loans are going to get paid off. They have a very low value to lenders. So the lender's thought process is if we collect some interest up front, we'll throw you a bone. We'll give
mm,
you a better, the deal to buy down is better, right? Like the upgrade price is cheaper than the base price. It's a better bang for the buck. It's kind of like going from a small coffee, like, to
right.
go from a small coffee at Starbucks to the medium is very expensive, but to go from medium to large is very small. Our guy taught us that. So if you look, that's the way lenders are viewing it because it's thinking like, hey, you've got more skin in the game, so we'll give you a better break on the rate. So as far as using closing cost to buy rates right now, yeah, it's definitely as good of a time as ever to do that.
Well, and thanks. So that makes sense. The question is then, okay, cool. Do you ever see where it might make sense to let's just use that 200,000? I mean, you're not getting anything for 200,000 right now, but let's just use it
Right.
as an
I know.
example, 300,000, whatever. Are you ever seeing, or when would it make sense, in your opinion, for the buyer to not say, Mr. Seller, you're going to get what you're going to get. If you want 300, you get your 300. We'd like to actually buy the house for more, potentially 305 if the house would appraise, and we'll use that 5 to buy down our rate, right?
Yep.
To help us. Do you ever see a world where that makes sense?
100%.
Yeah.
Absolutely.
And, and I'd love to do the math on that one day because that's something I talk to a lot of the agents that I coach. If you're working with a buyer and, to combat the affordability, will potentially 5K into a rate. And like you're saying, the difference between maybe 7.25 to get that rate down to 6.5. What is the difference? And does that $5,000 investment into that rate, in that payment, rather, not rate, and payment, what does the math look like? And I think oftentimes it does make sense to do that.
Yeah, I agree. And, I just thinking of it right now is that's a great play for when your offer is accepted, even just because
That's right.
it's so frowned upon within a multiple offer situation is even coming back and saying, hey, let's try this. And worst case, I mean, if the house doesn't appraise for that 5,000 extra, you give it back and it was worth a shot. But yeah, I agree with you 100%. I actually, in a lot of cases, I've done this multiple times where we see homes appraised for more than the purchase price,
Right.
which we actually see quite a bit. I always bring that up. And to that fact, I actually have a loan, it's closing today. But they had this house appraised $60,000 over the asking price. That was a house that it was just a good deal. It was kind of a rural house, appraised way over, but it needed a significant amount of work. Like it needed like plumbing and the yard stuff fixed, and it needed some flooring in the kitchen. And we actually negotiated. getting that work done and having that contractor being paid off as like a lien holder at the closing from the seller. So the buyer didn't have to pay for it out of pocket. They were able to essentially finance it. And then the seller was didn't have to pay it out of pocket because they just had it taken from their proceeds at closing after we increased the purchase price. So when you have a big gap like that, you have to find the right contractor, and that you have to be a good, like a heads up agent and a heads up loan. It was one of our better agents we work with, and she was, I mean, this guy got a great deal on a house, and then he got a whole bunch of work done to it before he moved in, and nobody really paid for it, right? And that
It's
it didn't have that
amazing.
big cash hit.
Well, and
So
that's just goes back to the argument of having a great team, a great financial
yeah,
partnership. And
yeah,
so, yeah, that's
100%.
why I think a lot of agents love working with you is stuff like that. The other question is, um are you still trying to get PIWs? Do you see that often? Do you not see it as often as we were last year?
So I'm not. So I have a couple loans in process with them now. So we are seeing them. Um, it's not as often as last year, but you've also the only way you get them on a purchase transaction is having 20% down, and that's because PMI providers don't accept them. So Fannie Mae and Freddie Mac will, but the companies that insure beyond 80% do not. But yeah, I see them. I actually see them quite a bit. So where there's 20, 30% down, your the highest likelihood to get one is to have 30% down. So that 70% loan to value number is a big one for that. I've actually had refinance transactions where I'll run it through at 80% loan to value if I'm doing like cash out or even a rate and term loan. Then I'll raise that property value to meet 70% and I'll get the property inspection waiver on that. So yeah, they're definitely still out there. If you see something that's wildly above listing price, it's probably not going to happen. But if it's within that area and current sales, then yeah, we definitely still see them.
And that's a huge takeaway for the audience. If you're watching this in our live mastermind and you're a real estate agent right now, it's like talk to the loan officer about trying to get the appraisal waived. It's just a huge, huge opportunity to knock off one of the big milestones in a transaction. Last thing for me, you know, we started off the show talking about what the Fed's trying to do to the economy, but the problem is they're not stopping with the spending. The best example of that in the housing market is what you just said a minute ago, which is all these multiple offer situations. You see, on one hand, interest rates are at 7% and people are screaming affordability crisis. Well, on the other hand, we still have multiple offers. So, how can both of those be true at the exact same time? Right. And so, I think what the Fed is saying is like, until that we stop seeing that, interest rates are going to keep going up. To which extent do interest rates need to be at 8.5% for us to be at no longer having multiple offers? That's like the chicken or the egg conversation. I find it so fascinating how both arguments are true. Like
Yeah,
nobody can afford anything, but there's multiple offers on every single listing.
yeah. It's weird.
You know what I mean? It's like, what do you mean? I
I
thought they
mean,
couldn't afford this. Why is there so many people wanting to pay more for something when nobody can afford anything? And I think that is the bow on this conversation, why the Fed continues to raise rates to make that statement not true, correct?
yeah, I mean, I think you also have to look at what you're renting for the same monthly price. That's the biggest thing I'm seeing right now is like, okay, now we understand payments and costs and rates and markets. And I mean, really to see rates go much beyond where we're at right now, I don't know. It would take a good move. I mean, we've been in this
Yeah.
rut for a while. I'm never say never, but the rental rates compared to, I mean, what you're getting for renting at the same price, for what you're getting for a purchase, you're still better off buying a home, and I think that's got a lot to do with what people are looking at. Because rent, I mean, it's not fun paying $3,000 a month to rent
People are like, well,
to get three
why
bedrooms
does
and
the
two
Fed
bathrooms.
continue to try to
No,
wreck this
you're
thing? And the
right. But I
reason
think,
is because
I
of
guess
what
what I'm
I believe I just said.
seeing or
Until they
want your
see
thoughts are on.
that unemployment is going way up, until we
Yeah.
see the spending frenzy go down, which is driving these prices up, until you're no longer getting multiple offers on a house with 7% interest rates, the Fed will not stop. I'm
Right.
asking your opinion. Do you believe that that is what they're trying to do?
Absolutely. I mean, they're trying. It's they call it demand destruction. That wasn't
That's
like
exactly right.
a made up word. They're trying to quell demand for these things, and they just can't. And that comes from, we talked about it multiple times, employment. I mean, wage growth is up. You look at the JOLTS report, and for every unemployed person, there's 1.7 job openings. That's
Crazy.
mega leverage. To use an F1 term, it's mega, right?
Yeah,
Like you've never been in a better place to be happy with what you do for a living than you are now and to get paid the most possible.
crazy. Crazy. Yeah, demand destruction. Anyway, appreciate your time, and we'll see you next Friday.
All right, man. We'll see you. Thanks.